Welcome to the StockOptionAssassin.com's Trade of the Week video. My name is Eric, and this week's video we're going to take a look at the Nasdaq. Now the Nasdaq has been kind of beaten up. It's definitely underperforming the overall market. We're going to be looking at the QQQ, but a couple things are happening the last few days that are making this look pretty interesting. And because this week is May options expiration, I think we have a couple days to kind of stalk this trade and get in. So here's what we're going to be looking at with our MTS members and potentially looking to buy some calls on the Nasdaq. So, and again, that ticker is QQQ. So what we're looking at, first of all, is that the Nasdaq had been in this downtrend, and basically over the last couple of days, it's broken that downtrend and it got back above the 50-day moving average. Now, this is the 50-day simple moving average, and we closed above that. Now, granted, we had this kind of big pop up the last couple days, and today was kind of a doji candle, and we're kind of just sitting here. So for the next couple days, because it's options expiration, I actually think we get some choppy sideways movement. So if we can get a nice little bull flag or even a pullback back to this trend line, which is about the purple line, and that is the 13 EMA, we'll call it like 87.50, somewhere there. If you can get back into like 87.70, 87.80, somewhere in this range, and this holds, I would look to be buying some Nasdaq calls via QQQ. So I like that setup. Let's give it a couple days. Let's see if that sets up. Another thing kind of lending itself to the bullish case is the VIX. The VIX on Monday just got crushed. We've been talking about this with the members. It got crushed and is sitting down here in the $12 range. And if this is any indication of the fear in the market, then the VIX basically is telling us there is no fear in the market. So when we go back and look at like the SPY, we're actually breaking out the new highs today. So what we're looking at with the Nasdaq trade is basically a little bit of a catch-up play here. Now, on top of the mini breakout double close above the 50, we also have a squeeze setting up, and a squeeze is a very interesting type of play. And what that means is that the volatility is kind of low, and what we're looking for is the squeeze to fire long. And what that means is the volatility would be picking up. And at this point, it looks like that volatility is going to be picking up to the upside. So if this squeeze can fire long, you can see this is a squeeze that we had previously back in March, where the squeeze indicator was trending lower. The squeeze, indicated by the little red dots here, ended up firing short, and then we had this massive sell-off. So right now, the indicator is above zero. The squeeze is looking strong, and this thing, I'm looking for the squeeze to fire long. And if anything, the Nasdaq can just catch up to its recent highs. I think that that's going to be a good trade. So let's take a quick look at the option chain. So I'm looking at June options now. Remember, this may take a few days. There are some funky strike prices here. You could do a couple things here. You could go, you go out a little bit farther. There is a huge open interest here at the 89.63 strike, which is again, kind of a weird number. Don't ask me why that's like that. These are trading for about 95 cents. Give it a couple days. Let's say Nasdaq pulls back from, we're at 88.29. Let's say we get back, let's say it pulls back about $1 back to this trend line, about 87.30. So about $1. If we take a look at theoretical price, and we say in a couple days we pull back minus $1, the theoretical price of these options would be about 60 cents. You might be able to get in these for 60, 75 cents. This is just sort of theoretical price. But if they pull back and you can buy those calls, and then we get that move and we get a move back up, these things could easily double if the market cooperates and gets back up to those recent highs. So with something like this, you're pretty much risking the entire thing. And I tell members this: when you're buying out of the money options and you're looking for kind of that home run trade, with 60 cents, I would just go in with full risk. You can try to put a stop on it. If it starts to go and it doesn't work out, maybe you can close out. I would not go in with an initial like 30-cent stop or something, because this thing could pull back farther than we expect. So for me, when you're trading out of the money options that are less than $1, I prefer my stop to be my position size. In this case, I would go in with the idea that I'm risking the entire amount. So I'm basically risking 100% to try to make maybe 300% if the market really gets going. So again, right now, if they were worth 60 cents, if this thing pulls back $1. So if we go back up, let's do a theoretical price. Let's say this gets back up to, let's just say 91, so we're at 88.29. That would put us at, let's just say it goes up, $3. You can see those options, 89.9, they go to $2.41. So again, you get in for 60 cents. That's a 300% gain. Obviously, you have to account for a little bit of, theta. So, still, you might be able to get out for $2. So that's the play I'm looking for. You could go slightly, farther in the money if you want. I actually like the 89s. For some reason, these strike prices weird me out a little bit, but I do like that 89.63 just because it had a ton of open interest there, and somebody's doing something. So anyway, that's the play. I hope you enjoy it. Let me know if you have any questions, and we will see you at the next trade of the week.